Okay. Note that this is prep for Wednesday office hours, 6 p.m. Eastern time. And it won't be in sequence, but, for a while, we're going to look at financial Marxism as a field. It certainly doesn't exist in the United States, except in sort of certain fragmentary ways. For example, people like Michael Hudson, et cetera, write about what counts as financial Marxism. I mean, you could even say that modern money theory addresses certain financial Marxism stuff, even as it, is simply quote unquote about money. Um, Certainly, currency is one part of the issue, but as we've seen in prior readings, that talking about things like credit and debt are certainly financial matters, as some of us have probably realized. And so the point is, there's literature for it, and we shouldn't forget about it. So, switching to the article at hand, there's an article by Rune Skarstein, Overaccumulation of Productive Capital or of Finance Capital, a view from the outskirts of a Marxist debate. And I just, will say that it is a outskirt simply because, there's all this addressing about anti-imperialist Marxism and the hegemony of, sort of academic Marxists, professional managerial class Marxism. So whatever. Um, this doesn't deny the issue of class struggle. Um, the labor theory of value, all of those things are not gone. They are simply, you know, uh, in a different form, and they still are there. They and if you believe in any kind of quantum modeling or whatever, it is always still there. It's just that it's not something you necessarily organize around unless you're going out to organize stockbrokers, which futile task, undoubtedly. Uh, Needless to say, this is what we're going to look at for a bit. And so I'm going to start reading it just simply because we need to sort of move our ideas further along. All right. Introduction. The prevailing Marxist explanations of the present economic crisis faced a double dilemma. First, the crisis started in a period when the rate of profits in the corporate sector of the United States, US, according to current measures, tended to rise in the period from 1982 to 2007, with a small dip in 1997 to 2002, .com. And then there's, the front end, which is, Reaganism. And then, of course, the back end, which is the financial crisis. After falling from the mid 1960s to the early 1980s, Dumanel and Levy, Wolf, Mohun, Sheikh, etc. However, Marxist theories explain crises as a result of a falling rate of profits. And second, many Marxist economists concede that the crisis was triggered by processes in the financial sector, which is unproductive in terms of surplus value, but they deny that the causes of the crisis are located in that sector. In other words, Marxist explanations tend to ignore that the dynamics of the financial sector could be, in fact, sorry, could be the ultimate cause. The dynamics of the financial sector could be the ultimate cause of economic crises. Now, that is overstating the matter, but ultimate cause, or even the penultimate cause, doesn't mean it's the only cause. And I think it's really important to see how that all fits in, because they're at the same moment that these crises were occurring, there's all kinds of other stuff going on, and important stuff that relates not only simply to the formation of the financial crises in terms of creating issues related to mortgages and debt and et cetera, but also the structure of the world economy at the time. And needless to say, there's deficits from fighting a war or invading Iraq, let's put it that way. All those other things were going on at the same time. So in this paper, I will first discuss some aspects of Marx's theory of surplus value and profit, which suggests that finance capital may temporarily be decoupled from the productive sector. Now, even to state that can be problematic from all kinds of materialist points of view. So hopefully you can put that in suspension for a moment. The word decoupling in the context of historical materialism may cause trouble. Anyway, on which it of course depends for its hunting of profits. Then follows a section discussing the basis of financial profit seeking, i.e., aspects of the quote unquote real economy, which have been essential for the accumulation of finance capital in the last 2 or 3 decades. The next section discusses new means of financial profit seeking, so-called financial innovations, in the last about 20 or so years. The final section argues that the present crisis was caused by overaccumulation of finance. Overaccumulation of finance capital in relation to its profit possibilities. This crisis has turned into a general economic crisis characterized by increasingly deficient effective demand. Now, the increasingly deficient effective demand does address this, the tendency for profits to fall, blah, 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 or overaccumulation and et cetera. So it's still all there. It's just you're looking at different, components of it. Let's put it that way. Although I know you can see that this is an issue, but I would assert to you that looking at the financial capital sector, not that different from looking at it in the 19th century context. I mean, there are more instruments, there are more institutions, but it has all the same features. And as I think you can say, increasingly deficient effective demand is certainly part of one way to characterize it at a macro level, which has, of course, other implications for structural dynamics and a bunch of other things. But one should crawl before one walks, I suppose. Some aspects of Marx's theory of surplus value. The omission of the dynamics of finance capital in Marxist economics may have its origin in Marx's own work, in his theory of economic crises, and most conspicuously in his discussion of the tendency of the rate of profit to fall, the TRPF. His focus of analysis was the direct relationship between capital and labor in the surplus value productive sector of the economy, with industry as the outstanding example. Now, this is no wonder, because since the financial sector was rather, quote unquote, underdeveloped at Marx's time. Now, it doesn't mean that the sector wasn't important. It was just underdeveloped. That there's a difference. And I think you could see that in the nature of financial crises in the 19th century. And I hope that people will appreciate that. Considering that is the kind of formative thing that Marx is confronting, or at least it's one of the causes of the things that caused, revolutions, overthrowing monarchies, et cetera, it all still has it's economic in the last instance necessarily, hopefully. However, Marx analyzed credit and the banking sector and made clear that interest is a part of total surplus value originating from the productive sector, and therefore, other things being equal, implies a reduction of profits in the productive sector. So note that total surplus value originating from the productive sector, and then, other things being equal, ceteris paribus, perhaps, a reduction of profits in the productive sector. So if you still have a productivist concern or bias, or you prefer Department 1 over Department 2, they're still there and still together. Productivism is still at work. In its analysis of the equalization of profit rates within and between sectors, he showed that the profit extracted by each single capital may be different from the average profit of total capital for two reasons. First, the rate of surplus value, that is, surplus value divided by the value of labor power for each single capital, could deviate from the rate of surplus value of total capital. And second, the value composition, that is, the value of constant capital divided by the value of labor power, that is, variable capital, of each single capital, could deviate from the value composition of total capital at equal rates of surplus value. Now, of course, there can be a wide variety of combinations of these two reasons. So, in other words, as a consequence of capitalist competition, the profit rates of single capitals tend to be equalized as capital moves from branches or sectors with relatively low rates of profit to branches with a higher profit rate. The main point here is that the single capital will not in general realize the surplus value which is produced under its command. By contrast, equally large capitals which command quite different quantities of surplus labor, i.e. produce different quantities of surplus value, bring equally large profits. In other words, in the equalization of the rates of profit, the quantity of profit of each single capital is not determined by the quantity of surplus value this capital has extracted, but by the value of advanced capital that has been advanced, multiplied by the general rate of profit. Now, even capitals which do not command any surplus labor will, to the extent that competition results in equalization of the rates of profit, harvest a profit which is more or less proportional to the advanced quantity of capital. This means, though, that through capitalist competition, all forms of capital, including finance capital, harvest a profit which is more or less proportional to its size and varies around the general rate of profit. Marx emphasized that, quote, it is the rate of profit that is the driving force in capitalist production, and nothing is produced save what can be produced at a profit. Now, note, of course, there are other contingencies built into the creation of a rate of profit. It's not as, easy or simple. It requires lots of empirical stuff. Because profit seeking is a driving force in the capitalist mode of production, many capitalists will consider the surplus value productive sector of the economy as a troublesome or unnecessary roundabout. Now, noting, of course, that roundabout is a circuit, right? So this seems unnecessary, but I would assert to you that it's quite essential. Money capital, which seeks profits within the financial sector, makes a shortcut in its hunting for profit. Therefore, it's not granted that profits realized in the surplus value productive sector will re-enter the circuit of capital in that sector, even if effective demand for consumer goods, investment goods, net exports is sufficient for the realization of surplus capital as money capital. Now, Marx saw clearly this aspect of capitalism. So, quote, that's precisely because the money form of value is its independent and palpable form of appearance that the circulation form M-M prime, that is money, more money, which starts and finishes with actual money, expresses money making, the driving motive of capitalist production most palpably. The production process merely appears simply as an unavoidable middle term, a necessary evil for the purpose of money making. This explains why all nations characterized by the capitalist mode of production are periodically seized by fits of giddiness, in which they try to accomplish the money making without the mediation of the production process. So, you can see sort of Marx is being a little flippant there, close quote, notably. He also pointed out that, quote, the circuit M-M prime is the absolute form of capital which valorizes itself, right? Now we find M-M prime as subject. In M-M prime, we have the most vacuous idea of capital, the distortion and reification of the relation of production in the highest power. Capital appears in a form where it seems to be an independent source of value. This is partly due to the fact that its contradictory character is wiped out, as it does not appear to be a contradictory relation to labor. Now, that's one way you could look at it, and certainly Marx, close quote, that's one way in which Marx looks at it, on the one hand. On the other hand, after all the writing of Marx and editing by Engels, etc., you could see that there's a little bit more going on here, and that I would assert to you that the contradictory character is not really wiped out. And I think that just the actions of an economy and history has shown that to be true. But anyway, however, there appears to be an ambivalence in Marx's conceptualization of money capital in the form of share capital or other types of securities when he characterizes these forms as, quote unquote, fictitious capital and their market price, that is the market for, capital market, as illusory capital value. Now, possibly this ambivalence combined with the underdeveloped character of finance capital at his time is the reason why he analyzes money capital only in its direct relation to productive capital and does not examine the endogenous dynamics of finance capital. And at that, there's other literatures that come on later on finance capital from the Marxist point of view, Hilferding, I guess, probably need to look at. Also, there is an inconsistency in Marx's representation of the rate of profit. As we've seen, he says clearly that all capital, including all types of interest-bearing capital, participates more or less in proportion to its size in the distribution of total profit. Then finance capital should also be included in the denominator of the general rate of profit. Now, however, he includes only productive capital when analyzing the tendency of the rate of profit to fall in volume 3 of Capital. Now, let me break here for a second. There's a whole bunch of stuff related to, third volume literature that is important here. And we note that still needs to be considered. So in doing this, he is not alone. In national accounts, capital is represented only as real capital in terms of implements or its implementation, such as machines and buildings. Now, note already, this is kind of what we were fiddling around with, and from a rent point of view, recall that that's what's going on as well, i.e., by and large, capital which sucks up surplus labor. Finance capital which hunts profits within the financial sector without any direct contact to the real economy, is not registered in the national accounts. Therefore, the tremendous accumulation of finance capital, especially after 1990, is not visible in the national accounts. Finance capital is not included either in the calculations of capital output ratios, nor in the calculations of profit rates. Note, of course, that these issues are addressed by other, Cockshott, a bunch of other folks, some of these, and that our ability to estimate all these things is, of course, there, just not emphasized. Back to the text. Probably the reason for this omission is a view which is apparently shared by most economists, from leftist Marxists to even Keynesians, that magnitudes in the financial sector mirror magnitudes in the real economy, in the sense that they are the result of interactions between the real economy and the financial sector. Now, this is not the same. It's not the same as the veil of money, quote unquote, veil of money in neoclassical economics. However, it implies that accumulation of finance capital cannot, even in the short periods, take place on its own, virtually decoupled, there's that word again, decoupled from the real economy. In my view, this conception is wrong. Now, of course, large parts of the financial sector, especially much of banking and insurance, note that, please, are a necessary component to the productive sector of the economy. However, the financial sector has grown far beyond the size and the functions needed to provide loans or insurances to the productive sector. Instead of financing investments in the real economy, the financial sector has established its own circuits of capital, making financial investments and realizing temporarily huge profits from such investments. Now, this is that question of establish its own circuits of capital, and this is, in fact, the crux of one way in which you could examine the financial crisis of 2007, 2008. Roughly speaking, that part of the financial sector which is mainly involved in the trading of securities of all sorts, and which develops ever new types of securities to make profits on that kind of trade, represents accumulation of finance capital. However, ultimately, the profit seeking of finance capital depends on particular conditions in the surplus value productive sector of the economy, which of course has changed over time. Particular conditions. This is where, we're going to try and, work through what that means. First, I will therefore discuss aspects of the real economy which have been essential for the accumulation of finance capital in the last 2 or 3 decades. Now, I would note to you, just let me break for a second here and say, it's true that there are a lot more layers to, looking at finance capital. But I would assert to you that the structure of it is not that horribly different from the 19th century in terms of the formation of certain things that, we begin to see addressed at the turn of the 19th, 20th century. And we can see operative, and that also are part of the crises that occur during that same historical period. But anyway, the basis of financial profit seeking. The rising dominance of shareholder value. An important aspect of the turn to neoliberalism of around 1980 was the increasing emphasis on shareholder value. Note, of course, that shareholder value is one of the real problems that we've seen, is that, shareholder value, trumps, anything that, the sort of benefits that would be trickle down, as it were, to consumers. But anyway, that's a whole nother story. This turn reflects a change of power relations within the corporate system. Yes, it does. Advocates of this change argue that because the shareholders are the owners, corporations should be subject to quote unquote shareholder democracy. Also, now shareholder democracy, quote unquote, is an important issue because is it truly democratic? It is, it may be pluralist at some point, but in a larger sense, morally speaking, perhaps it isn't. Anyway, also this ideology, the ideology of shareholder system democracy, this ideology holds that the shareholders are the actual risk takers in the enterprises. Now, for this reason, the objective of corporate management should be the quote unquote maximum increase of shareholder value, and management remuneration incentives should be designed to serve that purpose. The increasing emphasis on shareholder primacy has led to a significant change in the distribution of profits between dividends and retained profits. In the United States, dividends as a proportion of total profits in non-financial companies, excluding farming, doubled from 24.7% in 1980 to 50.1% in 1990, and remained roughly at this percentage until the end of the decade. After 1997, total profits started to fall from a level of almost $500 billion in 1997 to about $325 billion in the dot-com crisis of 2001 to 2002. However, the volume of dividends continued to rise in the whole period from 1989 to 2003, exploded after the year 2000, and reached a stunning 87% of total profits in 2003. As Aglietta and Reberu point out, quote, thus, for 20 years, we've been observing a regular rise in dividends completely detached from movements in profits. For the last 2 decades, shareholders have succeeded in partially guaranteeing their income against trading fluctuations, thus significantly reducing the risk they incur. Consequently, the argument that the firm should be managed in the exclusive interest of its shareholders because they are the ones incurring the risk loses a lot of its validity, close quote. Now, there can be little doubt that the increasing emphasis on shareholder value, implying a redistribution of profits in favor of shareholders, has facilitated the accumulation of finance capital in the recent decades. However, this process was also conditioned by the stagnant effective demand and foreign competition in the U.S. economy, leading to a low growth rate of real investments. From 2000 to 2006, private investments, excluding housing, rose by only 6.5%, while the gross domestic product, the GDP, rose by 16.3%, thanks to a relatively strong rise in private consumption. That's in OECD data. Thus, stagnant demand for U.S. produced goods facilitated the change from real investments to financial investments. Moreover, the run for shareholder value fueled inflation in share markets around the whole world, which of course implied rapidly rising capital gains for shareholders as long as the party was going on. The New York Stock Exchange index rose from a then historical peak of about 4,700 points in August 2000 to a new historical peak of about 10,600 points in July 2007. However, between the 1st of January and the 11th of October 2008, the total market value of shares in U.S. corporations declined by 40% from about 20 billion US dollars to 12 billion. And also in other countries, this fall of share prices was about 40%. Sorry. Now, subprime lending, house price inflation, and mortgage refinancing. Many commentators argue that subprime lending in the US caused the financial crisis. In my assessment, this is an exaggeration. Yes and no. But, of course, subprime lending did play a role. According to the newsletter of US mortgage banks, Inside Mortgage Finance, total payments of subprime loans in the period 2000 to 2007 amounted to $2,500 billion. In March 2007, the value of subprime mortgages in the US was estimated at $1,300 billion. Now, these figures represent modest amounts compared to the estimates of the total federal rescue package. Now, that's a whole, that has all of its own issues, too big to fail, etc. In March 2009, Bloomberg News reported that the US government and the Federal Reserve had used, lent out, or pledged 12,800 billion US dollars, or 42,100 US dollars per household. In July 2009, the Special Inspector General for the TARP, Troubled Assets Relief Program, Neil Barofsky, stated that the total federal rescue package could reach $23,300 billion. Now, these figures indicate that far more than non-performing subprime loans burden the assets of U.S. banks in the financial crisis. The defaults of subprime borrowers may have triggered the crisis, but were not its decisive cause. Now, that raises a whole bunch of other things and questions that, of course, I refer you to Michael Hudson to sort of work through the history of that. Large-scale refinancing of real estate, primarily homes, made possible by a low interest rate and the price inflation of houses. Note, of course, Trump wants to, at this moment in time, Trump is actually in favor of price inflation of homes, needless to say, mainly because he wants a low interest rate for other kinds of reasons other than related to real estate. Anyway, was apparently a more important cause. Only in 2005, %40 of existing mortgages were refinanced. Such transactions contribute considerably to the steep rise in total debt of households, especially from 2000 onward. So, Table 1, U.S. household debt by the end of the year 2000 and 2007. So, without going too far deeply into there, total household debt increased by 97% from 2000 to 2007, reaching 13,800 billion US dollars, corresponding to 133% of disposable income in 2007. Mortgage debt contributed strongly to this increase, rising from 69% of total debt in 2000 to 76% in 2007. This is what you see in Table 1 above. However, it should be noted that the subprime debt of 1,300 billion US dollars represented less than 10% of total mortgage debt. Although mortgage refinancing homeowners obtained, quote unquote, free cash. Through mortgage refinancing, homeowners obtained free cash for consumption. This explains why private consumption in the US rose by 20.1% from 2000 to 2006, which was more than the growth of GDP at 16.3%, although real wages increased really very little. And this is part of the overall question of divergence. from wages. The virtual destruction of labor unions was an important condition for the low-wage policy in the U.S., but that's been going on, not during this, has been going on for a century, whatever. The proportion of unionized labor in the private sector declined from more than 30% in the 1950s to 24% in 1976 and barely 10% in the year 2000. The real wages of workers in the non-agricultural private sector in 1982 peaked in 1972 at $8.99 per hour, and by 2006 had fallen to $8.24 a dollar, despite the enormous growth in productivity in that period. So from 2001 to 2006, the average real wage in the U.S. rose by less than half of the productivity growth. Through this process, the wage share in the U.S. economy declined while the profit share rose correspondingly. Thus, credit-financed private consumption compensated to a large extent for the stagnation in wage-financed consumption and led to a higher overall effective demand and higher employment than would otherwise have been the case. So, there's distortions built into the figures. According to one estimate, consumers drew more than 9,000 billion US dollars in cash out of their home equity from 1997 until the end of 2006, an amount equal to more than 90% of disposable personal income in 2006. Another estimate indicates that the free cash originating from this debt process rose from an average of 5.2% of disposable household income in the period 1991 to 2000 to 11.9% in 2001-2005. Only a small rise in the interest rate was sufficient to bring a large number of households into economic distress with difficulties in servicing their debt. The bubble had to burst sooner or later. Next section, the turn to mandatory fully funded pensions. The essential aspect of the pension reforms in Western countries around 1990 is the shift from mainly pay-as-you-go schemes, where current payments of pensions were financed through current taxes, to fully funded pensions. In the fully funded schemes, a part of workers' income is deducted to be saved individually, collectively, for later pension payments. The neoclassical argument for this change is that the transition to full funding would cause a once and for all increase in total savings, and as a consequence, an equivalent increase in the capital stock and output per capita. This output increase should prepare the society for future aging of the population. You can see how contradictory that is relative to schemes, like squeezing the Postal Service in the United States, etc. It is an open question whether fully funded pensions will actually lead to higher total savings. And more importantly, this argument is based on the pre-Keynesian view that savings determine investment, not vice versa. So we're looking at the end of the 19th century, beginning of the 20th century, as pre-Keynesian concept. Note that I just made a comment about how there is a structural similarity, not identical, clearly, in terms of the economy at the time, and equally so the ignorant attempt to return to certain ideas popular at that time, i.e., tariffs. Anyway, also, the argument ignores Keynes's savings paradox that increased savings will result in lower effective demand and lower output in situations of less than full employment. So on the other hand, it's evident that the fully funded schemes have led to an enormous rise in the assets and turnover of different types of institutionalized pension funds, as well as pension savings managed by insurance companies. According to estimates made by Morgan Stanley, by the end of 2007, pension funds globally managed a capital of $22 $8,000 billion, 1.6 times the US GDP, while insurance companies managed a capital of $18,000 billion. In the climax of the crisis, virtually all pension funds around the world experienced that funding of pensions is a dangerous game. From the end of 2007 until the end of the first quarter of 2009, U.S. private pension funds and state and local government employee retirement funds had a combined loss of financial assets of 3,195 billion US dollars, corresponding to a writing down of assets by 33%. Now, the growth of sovereign wealth funds is also interesting here. This is the next section. Many countries with large and persistent trade surpluses, especially petroleum producing countries, do not need all their foreign exchange earnings as reserves with their central banks. This situation has given rise to the growth of sovereign wealth funds. Note that there's lots of scheming with this at the present moment in certain places, notably in oil-producing countries, but there's a whole nother set of issues there. After the mid-1980s, these funds have grown to a considerable size. At the end of 2007, the total sovereign wealth funds globally amounted to 2,876 billion US dollars, most of which was invested in shares and bonds. Of the total amount, 2,103 billion US dollars, or 73%, were petroleum-related funds. Table 2 shows funds of 50 billion US dollars or more at the end of 2007. So this table 2 is sovereign wealth funds of at least 50 billion US dollars at the end of 2007. So you can take a look at this list here. It's an interesting list. And of course, note that where's Venezuela in this, as though, that had some importance relative to reserves, et cetera. And see, it's not quite the same thing. And of course, we know that United Arab Emirates, owns certain things that are part of the Trump portfolio right now. 49% of Liberty Financial, I think, was squirreled away or moved. And for what reason is a whole different set of questions relative to crypto, but that's a whole nother story. Anyway, the majority of these funds, the Chinese fund is an exception, it's always an exception, are solely hunting the largest possible and at the same time reasonably secure returns from investments in international financial markets. Thus, they represent a considerable addition to the accumulation of finance capital in general. The states leave the management of the funds to brokers and investment banks, which have cash large fees for this activity. This is the whole, the underlying motivation. Since much of the funds are invested in shares, there's reason to assume that they contributed considerably to the price inflation in share markets up to 2007. Next section, the rising deficits and foreign debt of the United States. The special role of the US dollar as trade and reserve currency in the world economy has implied a rising international demand for the US dollar. This is not only permitted, but to a considerable extent necessitated the United States to run large and permanent deficits in foreign trade, upon which you can see the parasitic nature of current administration policy. The U.S. had foreign trade deficits in all years from 1976 to 2009 and current account deficits in all years in the same period except 1991. In the period 1982 to 2006, the accumulated trade deficit in the United States amounted to 5,545 billion US dollars, while the accumulated current account deficit in the same period was 6,168 billion US dollars. In 2006, the current account deficit reached a historical peak of $788 billion US dollars, or 6% of GDP. Now, the current account deficits imply a rising foreign debt, and the net foreign debt of the US doubled from 2002 to 2009. This is republicanism at work. Today, the US has by far the largest net foreign debt in the world. And in 2006, the net foreign debt of the US was twice as big as the total gross debt of 3,243 billion US dollars of all developing countries. This is IMF data. Table 3, the financial balance of the US with the rest of the world. So, it's perhaps hegemonic or whatever to look at that kind of comparison, but it really is important relative to, the effect or hegemonic effect on the global economy. And noting, of course, that this has a domestic effect on, what we do, despite all those other structural problems. So the point here is related to the trade deficits. TD are general government public sector deficits, GD, and private sector deficits, PD, where PD plus GD equals TD, trade deficits. The trade deficits are a function of general, that is, government public sector deficits, and private sector deficits, which certainly should be obvious. Thus, one should speak of a triple deficit in the US economy. For the 25 years, 82 to 2006, the accumulated public sector deficit in the US amounted to 5,624 billion US dollars. In 2010, it is estimated to reach 1,556 billion US dollars, corresponding to 10.6% of GDP. The rising deficits in 2009 and 2010 are mainly due to the rescue packets to the financial sector and the expansionary fiscal policy to counteract the crisis, the taking on of toxic debts and blah, 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 blah. However, before the crisis, the general deficit rose from almost zero in 2001 to 4.6% of GDP in 2003 and 2004. War is good for doing this. This is due to the Bush administration's tax cuts, favoring the rich, that's where we are now, as well as rapidly rising military expenditures in Iraq and Afghanistan. This is the same, I'm sorry to say, there is a structural similarity between that period, invading Iraq, and whatever we're doing now, which amusingly could include, attacking Iran, but it is also combined with other, small time, as it were, efforts like seizing control of Venezuela's oil and the like, and starting a fight, an unnecessary trade fight with the rest of the world. There's an intimate relationship between the U.S. public and private sector deficits and the current account deficits. Public deficits are covered mainly by issuing government securities, treasury bills, and bonds, which are mainly sold abroad. Dollars accumulated as trade surpluses by foreign countries are recirculated back to the U.S. mainly through purchases of U.S. government securities, which are sold to finance the budget deficit. Net foreign acquisitions of U.S. government and government-backed securities increased from 150 billion U.S. dollars in 2000 to a historical peak of 963 billion dollars in $96.3 billion in 2008. See Table 3. The largest assets in U.S. dollars are held by China, accounting for 27.8% of the U.S. trade deficit in 2006, Japan, and the oil-producing countries in the Middle East. In 2007, dollar-denominated U.S. securities at an estimated value of $3,500 billion were held by Saudi Arabia, and other oil producers in the Middle East. By March 2010, China was holding U.S. Treasury bills and bonds at an estimated value of more than $895 billion. Thus, the U.S. government issuances of Treasury bonds serve a double purpose. They, of course, cover the government deficit as well as the current account and trade deficit. You can see where we are now as having symptomatic implications. The trade in U.S. government securities has also represented an important income for U.S. financial institutions involved in that trade, and in addition, represented an enormous source of liquidity to the U.S. financial sector. From surplus countries there has been an ever-rising demand for U.S. securities, and the money flooding into the U.S. has bid up government bond prices, lowered interest rates, and has led to, yes, rising house prices. So even when the Federal Reserve started to raise short-term interest rates in 2004, long-term rates declined. The flow of dollars into the U.S. financial firms, including mighty investment banks and large universal banks, led to a soaring of profits in the whole sector, as well as an enormous growth of bonuses for top employees and claims for a more financial liberation. Kenneth S. Rogoff believes that with 800 billion US dollars of net capital flows pouring into the US in a year, some slippage of regulatory and lending standards was perhaps inevitable. Well, he argues that, quote, the U.S. conceit that its financial and regulatory system could withstand massive capital inflows on a sustained basis without any problems arguably laid the foundations for the global financial crisis of the late 2000s. Geez, sounds like hubris. But anyway, in any event, the U.S. deficits leading to a pumping up of the financial sector with liquidity have been an important part of the basis of financial profit seeking. It should also be, got to get those low interest rates. It should be emphasized that these mechanisms have increasingly made the U.S. the effective demand locomotive in the world economy in the last 30 years. Now, you can see where we are now as certain attempts are made to, derail the locomotive for personal gain as opposed to any kind of national sense or loyalty to the U.S. economy. Ultimately, it is certain parties kowtowing to certain other parties that have always been there. So I think you can see in this little history here that it's the same people, it's the same players. It's just that simply some people have chosen to cast their lot for whatever compromise reasons with these other folks. But anyway, and for other structural reasons that have to do with other matters. But anyway, new means of financial profit seeking. Next section, credit derivatives. I'll stop here considering that we have other matters coming up, but I thought I'd get a start on reading this analysis, which is a reasonable analysis. As I pointed out, there's some issues, but needless to say, it's the kind of thing that we might start caring about. And note, of course, that there's not just one or two suspects in looking at, quote unquote, a financial Marxism. So perhaps I'll get back to this in the next video before Wednesday office hours, but Wednesday office hours, I will talk a little bit more about this and introduce perhaps the next component of discussing this kind of set of problems. This sort of lays the foundation for talking about ways in which we can approach certain structural elements here without getting into the awful mire that, well, what does this have to do with class structure? I think it's pretty obvious that there is a ruling class and it's making a lot of money, and other people, other classes aren't getting their share of it for all the usual reasons, and for all the same reasons that have been there for about 40 years. So one wishes that one could step back and say, well, all of this other stuff is amusing, all these distractions and theft and depravity and all this other stuff, but truly, it still is about, it's economic in the last instance, as they say. So anyway, I'm going to stop now and return you to your regularly scheduled program because we have um, Star Trek coming up.